in like 2 minutes we can start. Thank you. So we can start.
Hello, can you hear me? Hello, Victor, can you confirm? Okay. And can you see my screen?
Yes, we can.
Okay, sure. Hi, everyone. Good day, participants. My name is Iryna. I'm a virtual legal officer and corporate structuring expert at Legal Notes, a platform for tech companies operating globally that helps startups establish and maintain their legal structures in more than 70 jurisdictions. We've helped many startups protect themselves by creating and maintaining legal structures, including RWA tokenization projects. A little disclaimer before we begin. None of this information should be considered as a legal, tax, or investment advice. We've done our best to make sure this information is accurate at the time of this webinar, but laws and practices may change. For help with your specific structuring project, your tokenization project, please speak to our team. Today's agenda is designed for startups looking to democratize property investments. We will talk about three main approaches: tokenization, crowdfunding, and real estate investment trusts. Other structures, such as traditional property funds and co-ownership, exist, but tokenization, crowdfunding, and REITs are particularly relevant for fintech founders. Today, we emphasize the tokenization route and will have a high-level overview of the crowdfunding and REIT models. These models offer ways to raise capital from a broad investor base while complying with local regulations. The sections below describe licensing options in the UAE. Major jurisdictions would include Dubai mainland, which is subject to VARA licensing, Abu Dhabi Global Market, ADGM, which has its own licensing authority called FSRA, Dubai International Financial Center, DIFC, and the Securities and Commodities Authority, SCA. The key regulatory requirements, costs, advantages, and drawbacks will be discussed in this webinar. We'll start with the key topic, the tokenization route. Tokenization, in particular, tokenized real estate, converts ownership or economic rights in the property into digital tokens recorded on a blockchain. Each token represents a fractional share in an underlying asset and may convey rights such as income or voting. Smart contracts automate investor onboarding, transfers, rent distributions, making transactions faster and potentially cheaper. The concept of tokenizing real estate emerged in late 2010s alongside the rise of blockchain. The first noteworthy real estate tokenization took place in 2017 with the property in Manhattan. Real estate tokenization serves a dual purpose. It democratizes property investment for investors and streamlines capital raising for developers by leveraging blockchain technology. On the slide are the key benefits of this approach from each perspective, investors and developers. For investors, we can note that this fractional ownership entails the case where investors can purchase small fractions of high-value properties, lowering the barrier to entry and enabling greater portfolio diversifications. Tokenized real estate can be traded on secondary markets far more easily than traditional property assets, giving investors the flexibility to quickly buy and sell their stake and access capital when needed. Digital tokens open up worldwide investment opportunities, allowing investors to participate in properties across different regions without the usual geographic constraints. And every transaction is recorded on an immutable blockchain ledger, creating a tamper-proof ownership record that enhances trust through transparency and security for investors. For developers, tokenization allows to tap into global pool of investors beyond their local market, significantly expanding the potential sources of capital for the projects. By streamlining transactions and reducing traditional financing hurdles, tokenization enables developers to secure funding more quickly than via conventional methods. Projects can be financed more efficiently through token sales instead of relying on bank loans or lengthy private equity deals. Developers can raise funds without having to give away full control of the asset and may retain the property management capacity when tokenizing real estate. Blockchain-based smart contracts eliminate many intermediaries like banks and brokers from the process. By cutting out these intermediaries, tokenization lowers transaction costs and administrative burdens, making fundraising more cost-effective for developers. At least it has a potential to make it more cost-effective. However, the founders need to budget the cost of corporate structuring, legal works to make sure the project is fully compliant with the laws and regulations. And while tokenization provides these benefits, it also comes with legal and technical complexities. Projects must address regulatory requirements from the platform security to investor education to be fully compliant and to realize all those advantages of blockchain technology. So there are implementing real estate tokenization requires careful legal structuring to ensure that digital tokens truly confer rights in physical property. The market usual practice is to use a special purpose vehicle. Typically, it's a limited liability company or trust that holds title to the real estate asset. The property is deeded to this SPV, and the SPV in turn issues digital tokens that represent fractional ownership of the entity and indirectly the property. In this way, token holders don't directly own the land or building. Instead, they own shares or membership units in the SPV, and the SPV is the legal owner of the real estate. Dubai, though, has taken a significant step forward, enabling direct tokenization of real estate without the use of SPVs. Driven by the Dubai Land Department, VERA, Virtual Asset Regulatory Authority, the Dubai Future Foundation, and the Central Bank of the UAE. While this approach signals the future direction of global real estate tokenization, its success ultimately hinges on the proactive commitment and alignment of all those government bodies to turn the concept into a practical regulatory reality. As of today, no other markets can offer the same direct structure. So, in most of, well, let's say, in all other countries in the world, the real estate tokenization or asset tokenization in general still works through the use of special purpose vehicles. Now, typically, this SPV is not the only legal entity in a corporate structure of asset tokenization projects. RWA tokenization is a multiplayer game. In most cases, the tokenization projects consist of multiple entities in the group. The technology development arm, the SPV, or even multiple SPVs that often hold units of real estate separately, and then tokenize assets. And in some cases, a foundation or a DAO, LLC, DAO wrapper could be used that serves as an umbrella for the decentralization. Additionally to those group entities, there are multiple third-party players. In practice, many asset reference token issuers partner with licensed broker-dealers or crowdfunding platforms to handle regulatory paperwork, or use tokenization platforms that bake in compliance checks. The secondary trading of tokens also happens via licensed ATS or markets. The projects may engage with oracles, licensed securities or financial instrument custodians, token custodians. When it comes to real estate, property development and property management are also crucial players in the projects. And beyond those corporate entities, compliance and governance are critical. Tokenized asset offerings are in most cases treated as securities, meaning they must abide by securities laws on issuance, disclosures, investor qualifications. A compliance structure often involves filing exemptions or approvals. That often involves limiting sales to accredited or qualified investors, unless using a fully regulated route. Projects are expected to implement strict KYC AML procedures to vet investors and avoid illicit activity. This is not only the legal requirement in most jurisdictions, but also protects the credibility of the tokenized offering by keeping the bad actors out. A proper setup will address securities law, corporate law, tax implications, a complex mix that experts should navigate to keep the project on solid ground. Aspects like investor rights and governance must be codified clearly. Token holders should know that what rights their token carries. For example, profit share, voting on certain decisions, buyback provisions. These terms are usually set out in smart contracts in the code and also in traditional legal documents, prospectus, offering memorandum, token sale agreement, operating agreement of that entity. Ensuring alignment between the code and the legal documentation is the key best practice so that there is no ambiguity between on-chain processes and real-world law and agreements. Given this novelty and cross-disciplinary nature of tokenized assets, projects often engage experienced advisors when deciding the corporate structure and preparing all that legal documentation. By following these best practices, founders can create tokenized real estate offerings that are both innovative and compliant. Businesses are global nowadays, and many projects incorporate in the UAE with a plan of targeting other markets too. When it comes to jurisdictions, there is the rule of thumb. The jurisdiction that applies to your project depends on your investor base and investor target markets, where you are planning to actively solicit investors. If you are taking US investors' money, you must follow US rules. If you want to sell your tokens in Europe, prepare to comply with European regulations. That's the offering regulation logic. Okay, so here we have the details of tokenized asset offerings in most popular UAE jurisdictions. Dubai mainland falls under VARA's jurisdiction. That includes onshore companies as well as all other free zones except DIFC. DIFC has its own regulator called DFSA, and Abu Dhabi Global Market Free Zone has its regulator called FSRA. So as you can see, often tokenized money-generating assets are often treated as securities, and that might trigger Securities and Commodities Authority authorization. And here we have a short list of triggers that might bring your tokens into SCA jurisdiction. So security token would be subject to SCA regulation if the token grants equity, debt, profit sharing, or ownership rights similar to shares or bonds. UAE market nexus means that issuance, marketing, or trading occurs in or into the UAE, even by the foreign entities. But if you are targeting UAE investors, UAE residents as investors, then prepare to be subject to UAE regulations, especially when it comes to onshore residents outside the financial free zones. If you're planning public retail offering, which means that you are publicly advertising your investment opportunity, your tokens. Tokens are offered or advertised to retail non-professional investors, individual investors in the UAE. Then again, SCA authorization might be triggered. If tokens are listed or traded on a UAE-based exchange, ATS, or marketplace, that might also require you to obtain local authorizations. If you, as issuer, as a company, incorporate or manage the entity or operate from within the UAE mainland, again, SCA would be the regulator covering that activity. And also depending on the underlying asset type. So if token derives value from a company's profits or investment pool, that also makes that token a security. And most probably, if you are based onshore, you'll be subject to SCA licensing. Okay, and on the general requirements, they are similar in DFSA, VARA, and FSRA, the entity needs to be incorporated in the chosen jurisdiction. So if you are going to limit yourself to DIFC free zone or to ADGM free zone, you incorporate in the respective free zone. If you want to target UAE broadly, you incorporate onshore and you will be subject to federal licensing. Senior management and compliance officers must reside in the UAE. Management must pass fit and proper tests, often requiring 5 to 10 years relevant experience. Tokenization is the capital-intensive route. DFSA guidance indicates a base capital around $140,000 for platforms that deal in investments, and ADGM often expects around 250,000 or more in capital for similar activities. Application and annual supervision, which is basically a renewal fee, are also substantial. For example, VARA initially charges 100,000 dirhams, which is around $30,000 initially, and then 200,000 dirhams annually as a fee per regulated activity. So tokenization is really a cost-heavy game. Detailed anti-money laundering and know your customer procedures are required. Regulators also require cybersecurity audits, business continuity planning, and custody arrangements. Investment making marketing materials may need prior approval. In terms of marketing materials and marketing rules, UAE is quite a strict jurisdiction, and retail participation is often limited to professional or specific testing regimes. So if you were planning to target small ticket investors, not qualified investors, this is really a complex process. So we've talked about numerous benefits of tokenization, like global reach, liquidity, efficiency and automation, transparency. But as you can see, there are also some cons to it. Regulatory complexity, where multiple regulators might be involved. When it comes to real estate, it could be VARA, Dubai Land Department, Securities and Commodities Authority. Those rules are always evolving. It's a very young industry in general. So new rules and regulations come up constantly. Missteps can result in enforcement actions and high fines. Licensing fees and capital requirements can be heavy for startups. VARA fees alone can be hundreds of thousands of dirhams per year. Let alone the other additional costs for the structuring, legal support, and technology development. Technology risks are also there. Smart contract bugs, wallet hacks, and custody issues introduce new points of failure. The secondary markets for the security tokens remain nascent. Investors may face limited liquidity in practice for now until those secondary markets develop. And that takes us slowly to the next model, which might be a bit more cost-friendly. It's a crowdfunding route. Real estate crowdfunding uses an online platform to raise capital from many investors. Each property is typically held in a special purpose vehicle, and investors buy shares in the SPV, entitling them to rental income and a share of capital appreciation. Platforms such as Smart Crowd and Stake operate under this model and are licensed by a DFSA, which is a DIFC's regulator. Crowdfunding relies on conventional shares rather than blockchain tokens. Key requirements would include that the platform must be incorporated in the selected jurisdiction. Again, it's DIFC, ADGM, or mainland. And have a local office. Senior executive officer, compliance officer, finance officer must meet experience and fit and proper criteria. DFSA requires around 140,000 as the base capital for crowdfunding platform USD, $140,000. And ADGM's minimal capital may start around 10,000, but often needs to be around 250,000 for a viable business. And the Securities and Commodities Authority requires at least 1 million dirhams in paid up capital for crowdfunding operators. However, the fees are lower than for the tokenization licensing. Application fees in DFSA costs roughly $5,000 to apply and $10,000 annually. An additional 20,000 is required if the platform will deal with retail clients. SCA fees include a license fee and an annual renewal. There may also be a percentage fee per offering. FSRA of ADGM charges around $10,000 for the regulated activity of operating private financing platform. That's their terminology for the crowdfunding. And an extra 10,000 is payable for each additional regulated activity. So, for example, if your technical and business model includes custody, additional fees would apply, etc. Operational controls need to be planned carefully. Platforms must maintain separate clients' accounts, perform AML KYC checks, and provide robust IT systems. Retail investor limits apply also. For example, DFSA regulated platforms cap individual investment per property and overall holdings. Regular reporting to the regulator and audited financial statements are mandatory. And the secondary trading of investors' units is usually restricted to certain windows that are scheduled for those investor exits. Now, in terms of real estate investment trust, a real estate investment trust is the collective investment vehicle that pools money to invest in income-producing property, distributing most of its net income to unit holders. REITs pool multiple properties, providing regular dividend distributions and diversification across assets. Investors buy units in REIT, which may be publicly traded or privately placed. Real estate investment trusts provide exposure to diversified portfolios, commercial building, residential complexes, logistics assets, etc., and are run by professional fund managers. In the UAE, REITs exist both onshore and regulated by the SCA, and in financial free zones in DIFC and in ADGM. Dubai's 2022 REIT decree introduced privileges for REITs that hold at least 180 million dirhams of real estate and register with Dubai Land Department. They must also engage licensed fund managers, independent custodians, trustees, auditors, and property valuers. This model has certain benefits. REITs pool multiple properties, providing diversification across assets. Listed REIT units can be traded on exchanges, offering more liquidity than private property holdings. REITs operate under well-developed investment fund frameworks in the AFC, ADGM, or onshore, providing investor protections and clear governance. They also have some tax privileges, for example, a reduced real estate registration fee. If they qualify, if they have holdings of at least 180 million dirhams, as I mentioned, and also access to institutional investors because REITs are established under investment fund laws. They can attract institutional investors and list on recognized stock exchanges, increasing fundraising potential. But there are certain drawbacks. High setup and compliance costs. Establishing a REIT requires fund management infrastructure, independent trustees, auditors, significant capital. Manager licenses and fund registration fees can amount to hundreds of thousands of dollars. Borrowing and development caps are there. I think you can see them on the screen. There are certain limits in terms of how much they can borrow against the assets they own and the percentage of income they have to distribute to unit holders, which limits the risk but may reduce potential returns. Dubai's REIT decree demands at least 180 million dirhams in real estate to access privileges, making this model suitable for larger portfolios rather than single assets or startups. REITs must distribute most of their income and cannot easily retain earnings for growth. They are also subject to mandatory dividend policies and periodic valuations, which is the benefit for investors, but makes the operating model more complex. And just to conclude on all those three models we've discussed, tokenization, crowdfunding, and REIT structures each enable a fractional real estate investment, but suit different business strategies. Tokenization is ideal for Web3 native platforms aiming to tap into global crypto capital and offer secondary trading of fractional units. It demands significant capital, specific technology, and navigating evolving virtual asset regulations. But it positions at the cutting edge of prop tech. Very innovative model and a hot topic of 2025 for sure. Crowdfunding is a pragmatic choice for startups wanting to launch quickly with lower capital outlays. It offers broad retail access through regulated online platforms and aligns well with small ticket investors. Limited liquidity and investor caps, however, mean returns depend on assets' long-term performance. So basically, often unit holders, investors wait until the platform sells the property to see their return. And REITs are best suited to larger portfolios seeking stable income and institutional investors. They provide legal certainty, exchange listing potential, certain privileges we've discussed, and they require substantial assets, professional fund managers, and adherence to strict distribution and leverage limits. So there is no one size fits all model. The founders should assess their target investors, funding capacity, technology, and risk appetite when choosing between tokenization, crowdfunding, or a professional model like real estate investment trusts. In some cases, a hybrid approach may emerge. For example, a crowdfunding platform could later tokenize SPV shares, which might be like a phased approach where you save on initial licensing to test your MVP and then go into the tokenization route, which might cost more and require additional fundraising by the startup. UAE's regulatory environment continues to evolve, and the authorities have signaled support for innovative fractional ownership models that broaden investment opportunities. But still, the focus is on investor protection and investor safeguards. I think that's all from my side. We are ready for Q&A. I hope this webinar was informative, and I'll be happy to respond to any questions you might have.
Thank you, Iryna. Please feel free to use the chat box or the Q&A box if you have any questions. So if there are no questions, I guess we could end here. Thank you so much, everyone. The recording will be shared in your emails. And yeah, see you in the next one. Bye.
Thanks everyone for joining. Bye.